Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. Well, I'm going to try and go back and utilize the daily charts as we are very gradually starting to see a return of some sort of normality here. However, I have to say this is by no means a good-looking daily chart. Prior to the start of March, the market is too condensed with too much information. I have been tempted to wipe the slate clean and start again from scratch. However, that would dismiss some pretty obvious pieces of support, which may become significant in the future. Anyway, here goes. Looking at this chart, some things pop out. We have some congestion zones below the market, notably a Fibonacci-based area between 998 and 1016. That includes the April 2008 high at 998. A small congestion zone between 960 to 978 with a gap just above between 984 and 985. And a far superior and congested area between 872 and 908. These are the areas of the market will need to contend with below if it chooses to try lower once again. Currently, the market has pulled up and away from the Fibonacci-based congestion zone between 998 to 1016, up through the congestion at 1052, and also the 50% Fibonacci line for the whole of 2022 so far at 1051. But short of some light congestion overhead between 1105 and 1115. Eventually ending up around a lesser 38.2% Fibonacci line at 1069 for most of the part. No clear pattern as yet has started to emerge from the recent action, though I have drawn a prospective uptrend, currently 1026, though I fully expect this to be reassigned as only a weak two-pointer. So with that all being said, where are we and what may technically be next? Well, for starters, I'll have to refer, as I've done last week, to my annual review at the start of 2022 where I covered Chicago wheat in depth, and I'm going to move the chart over as well. Interestingly, in this annual review, I went back to what I called a big picture pattern that I had highlighted some 3 years beforehand. I quote from my annual review. The most important point going forward is a big picture pattern that I had outlined 3 years ago. This is what I wrote at the time, and I quote, "The interesting concept of a descending scallop pattern for the whole of 2012 to date so far. This pattern is not complete, but it has an interesting dynamic. The slope of the move down from 2012 to 2016 is the first element, and it looks like the long slope of an Olympic ski jump. 2017 to date is whether the market turns up at full speed and flies off at the highest point, currently, and in this case, the 613 high from last August. That August obviously refers, of course, to the 2018 high. Anyway, there is a further piece from 3 years ago about the descending scallop pattern, and I quote, "Now, descending scallops can be both bullish and bearish. In the case of a bullish scallop pattern, the market takes another more ragged and shorter dip before accelerating higher. A typical move up would be 1/3 of the length of the long ski jump onto the highest peak. In this case, it would be about 811, or about point X. It's too early to call it a target as the market may still expand the rise. A typical move down would be about 30% off the long ski jump, taken from the low of 387 or at about 217 level and off the bottom of the chart. It seems excessive, but I feel obliged to mention it." And that's the end of the quotes. Well, it may have seemed excessive back then, 3 years ago, but it certainly turned out to be a true pattern as prices reached point X at 811 back in November of last year. This is now where it became even more interesting, as this confirmed descending scallop pattern has morphed into a rounded bottom pattern stretching from 2012 to date. A key feature of this pattern is the bump. You see, the rounded bottoms often have a bump in the base which looks like a false break higher. This is where the dip back in 2019 comes in, as the action from December 2017 to May 2019 was this bump, and the market did form a full and proper rounded bottom pattern. Now, this rounded bottom has caused the market to rise up, breaking the 2012 high at 953 and moving up to the primary target for a rounded bottom at target X1 in the 1321 area. This leads me to a possible secondary target for such a rounded bottom, well off the top of my chart in the 1520 area. In fact, the target X2 is not completely off the top of my chart, as you can see it peaking just underneath the top. Please note that such secondary targets are usually very hard to achieve. This leads me back to what may be happening right now. You see this original descending scallop pattern that morphed into a rounded bottom. This very much now depends on what happens in the next few weeks and days. What you should look out for is some hesitation away from this month's high and close perhaps to the very recent 50% Fibonacci line for 2022 at 1051 even. Now these numbers may be finessed once we get back to the daily charts, but I don't think so. Possibly down to the Fibonacci congestion at 990 or even 977. As I've already mentioned, this is a possible projection from what is as yet a very incomplete and only a possible pattern so far. Chicago corn. So I've decided to go back to daily charts here once again, as the definition has improved, though I will still reference the monthly charts in my commentary. The most recent action has seen a peak in prices when the market hit the overhead rising middle time, currently at 792, of the April 2020 to September 2021 and bullish Andrews pitchfork. This was also within a thin congestion band between 767 and 789, which has within it the October and November 2012 highs at 775 and 767 respectively. The pullback was slow, and it was only at the changeover gap that we saw the start of a move lower, as last Monday had a big key reversal down, and the change saw prices start up below the March 2013 high at 719. In truth, the rest of this week's range has been in an area free from congestion apart from the March 2013 high. However, support has come from an old and unusual quarter. It's the old broken upper wedge trend line, currently at 694. And that's from the late December to late February ascending wedge pattern. You can see the effects as recently as yesterday, and when we have had an immediate countering bullish double as a pattern and possibly a pipe bottom as well. Hence, that seems to be the immediate support with the previously mentioned middle time as resistance. Now, one final point on the daily chart, you can look at the action since May 2021 as a rounded bottom, and the most recent moves, the start of the move higher from this pattern, and an initial target has already been reached, and that was 2 weeks ago at the May 2021 high at 735. The next target X on this daily chart, so it's target X on this daily chart, you've got to be aware of the two different X's. Target X on this daily chart is off the top of my daily chart in the 890 area. And that's all I currently have for the daily chart. Looking now at the long-term monthly chart, you can also see a much bigger rounded bottom developing from 2012 to date, with the annual key reversal up in 2020 being the origin of the latest move upwards. Then in 2021, the dip back was held unsurprisingly by the 61.8% absolute Fibonacci line at 524. And it's from there that we have seen the latest move higher. Now, all this action has two implications. The first one is that compared to Chicago wheat, the rounded bottom here in Chicago corn is seriously lagging behind in time. Whereas the wheat has already broken up over the lip of its rounded bottom, here in Chicago corn, prices only have only just now approached the significant 2012 high at 849, plus the congestion in 799 to 806 area. Both, it seems, could be seen as the second lip of the rounded bottom. However, there's another pattern that is currently operational, originating from the lows in 2020 and still running now. It is formed from the previously mentioned halfway hesitation. That is the situation we currently find ourselves within and the opportunities that are presented. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is AD Tofpik and ADM Investor Service International Limited. And here comes the final bit.